First of all, good morning, everybody. As I said already, my name's Eoin Fahy. I'm Head of Responsible Investing at KBI Global Investors, and I'm the chair at the moment of CDP Network Ireland. Our topic this morning, as you know, I'm sure, is Net Zero Initiatives Masterclass. And I think a lot of us certainly need a masterclass in all the many and varied initiatives there are in the area of net zero, which are frankly hard to follow. A little bit of housekeeping at the beginning. Little bit of housekeeping at the beginning. Sorry, first of all, if I could ask everybody not speaking to stay on mute, usual applies to minimize interference and so on. Then also, if you can put your questions in chat, and we remind you as we're coming towards the end of the formal presentation, just to put some questions in there. This is an invite-only event for investors only, with a relatively small number of people invited, manageable number. So we'll try and keep it reasonably informal and interactive as we go along as best we can. Particularly in the questions and answers. I think that, as I said already, net zero matters to everyone in our industry without a doubt. I think portfolio managers either already know or they'll find out pretty soon that the commitment to net zero and the issue of net zero is going to affect their buy-sell decisions almost no matter what they do, what asset class and what type of strategy they run. If it doesn't affect them now, it will soon. Compliance and risk executives know the regulators are on the case when it comes to net zero. Even this week, we saw our own central bank governor, Gabriel McLough, interviewed as part of Climate Finance Week, where he was, for want of a better phrase, all over this like a rash in terms of the importance of climate change to the regulatory framework. So clearly very relevant for compliance risk regulatory staff. We know that client servicing and business development staff either already have or they soon will have, if they haven't already, get plenty of inquiries and detailed queries from clients and prospects on this issue and so on. So I think it's particularly appropriate. It's hard to think really of any topic that is more relevant right across investment management firms. I think we're very lucky to have here with us Mahesh, who is the global lead of Net Zero Capital Markets at CDP. In his role, he works with financial institutions in setting science-based targets. Science-based targets are one of the aspects that he'll get into in more detail today, has particular meaning. But he works with financial institutions in setting those science-based targets and transitioning lending and, for our purposes, more relevant investment portfolios across the net zero. So I think he's an absolutely perfect choice in that sense to address us today. He's an advisor to the Glasgow Financial Alliance for Net Zero Task Force, which he'll talk about, I'm sure, in the run-up to COP26 later this month in early November. He's a staff working group member of the Net Zero Asset Manager Initiative. Again, something I know he's going to talk about in detail, and we all need to learn about in detail. A very important initiative. And also of the Investor Agenda. He co-authored the UNFCCC's inaugural Marrakesh Partnership Climate Action Pathway for Finance, which was released this year. And prior to joining CDP, he had a lot of corporate banking, nearly 20 years of corporate banking experience, including at Macquarie and elsewhere. So as I said, a pretty much ideal person, I think, to speak to us today on this topic. And over to Mahesh. Mahesh is going to be using some slides. Formal presentation will take perhaps 20-30 minutes. Might even throw in a few questions or interactions as we go through that section, and then we will open it up to questions and answers after that. Over to you, Mahesh, and thank you for joining us. Now, Mahesh, I can't hear you.
Sorry,
I don't know if you're not speaking. Yeah,
I was speaking. I was just trying to do two things at once, which is clearly too much for me. Can you see the main screen, or are you seeing my presenter screen?
We can see the main screen, Mahesh, and we can hear you loud and clear. Thanks.
Fantastic. Well, I'll kick off then. So thank you, Eoin, and thanks everyone for coming along today. I'll effectively be going through, I guess, net zero initiatives as they relate to investors. With a bit of starting with a bit of a history, and then going into a bit of a deep dive in what they mean, and then offering a CDP perspective, but we don't have to stop the CDP perspective. It's just fun that I can talk to with a bit more authority, I guess, and go a bit deeper into it. So yeah, here's the agenda of what I just outlined. I'll probably pause after each of these sort of segments to check for questions, and I try to build on what I'm talking about. So hopefully those questions get answered along the way. But if I do start using jargon or just say something that you just don't understand and it would help your understanding, please do interject, and I'm happy to sort of explain from that point of view as well. So from there, I'll kick off. So effectively, just to set the scene, what are net zero commitments about? Many of you will sort of know this, but I thought I'd just start here to sort of set the baseline. They're high-level public commitments to meet the goals of the Paris Agreement, and that being particularly Article 2.1c to align finance with those goals. And these commitments have specific short to medium-term actionable commitments. These commitments cover Scope 1, 2, and 3, including, importantly for these initiatives, financed emissions. And they have specific sub-commitments, goals, or targets for different types of institutions. So there is different alliances and the like for different types of investors, banks, insurers. I think importantly, at this stage, these commitments are industry-led and supported by civil society. So most of these convenings have come together with actors in the industry, so asset managers, asset owners, and the like, and particular groups that represent them. And then in many cases are supported by civil society, such as ourselves, UNPRI, UNEP-FI, and the like. Also what they are and what they're shaping to be, I guess, over their sort of acceleration in the last 12 months is a collaborative effort to solve problems and find solutions to decarbonising finance and the real economy. So as you will see as we go through this, and as per many of the questions you will have, all the answers aren't there. The pathways and how to get to net zero isn't 100% figured out. But these fora are places, or these venues are places for the industry to talk about how they might get there as a whole, as opposed to going it alone and doing it in a silo. And I guess important at this stage is they're not legally binding or currently enforced by any regulators. So as Eoin outlined, it's starting to emerge. Particularly, I'm based in London. Obviously, as you can probably tell from my accent, from Australia. Different jurisdictions are looking at it in different ways. In the UK, there's talk about sort of regulating, but even potentially legislating around what these commitments might look like and what companies and indeed financial actors may need to do when making these sorts of commitments. But as of now, they are purely commitments. I'll pause there if there is any questions in the chat or anything, just on that start. No? Great, I'll kick on. So what I'm going to go into now is to talk about the two investor-related programs. I'll start on this slide with a high level, then I'll go into a bit of a deep dive into what they mean. But the two initiatives as they relate to investors, and particularly investors that have assets under management. So there is some initiatives that are forming now for investment consultants and the like. This relates to investors with assets under management. So the first one, which I'm deeply involved with, is the Net Zero Asset Managers Initiative. So this came about late last year. I think it was kicked off in November or December. This is a collaboration between, it was started by IIGCC, so the International Investors Group on Climate Change, which represents a number of mainly asset owners. And they brought together ourselves, Ceres, who are US-based, UNPRI, IGCC and AIGCC, similar entities to the other GCC, but throughout Asia and Australia. As I mentioned before, asset managers. As of current, so as of today, there's 128 signatories with 43 trillion assets under management. From what I am seeing at COP, there'll be an announcement which will drastically increase that to probably over 150, and there's some quite large actors in there, so that should get over 50 trillion from what I'm seeing. Within that, within this initiative, there are 3 target setting protocols, so different ways to get there, which we'll go into in a bit more detail later. There's 3 overall commitments in this initiative and 10 actions outlined in the next slide. And there is a 5-member advisory group from industry. So there is 5 asset managers that form the main advisory group here, that consult with the civil society actors or the secretariat in sort of forming how this runs and provide the investor voice there. All of the signatories have formal biannual meetings where they all come together and discuss the initiative and progress and the like. The second one being the Net Zero Asset Owners Alliance. So this is actually one of the first net zero finance alliance that came out mid last year. UNEP, FI and PRI convened and again led by industry. A current 46 members and 6.6 trillion in assets under management, due to grow with an announcement at COP as well. They have their own target setting protocol, but do encourage members to look at others as well. Really what they do, being asset owners, and you will know this very well, asset owners and asset managers sort of have different roles in the financial value chain, and asset owners sort of direct and outsource assets under management. So the Asset Owners Alliance looks to publish sort of positions and discussion papers on the views of the alliance to sort of signal to the market where their thoughts are. So to signal to those that serve them, and very much those companies that they invest in, as to where their thoughts are and what they're looking at. And they follow a commitment statement, which we will also go into. So I'm going to go into the next one. These shares will be slide afterwards, so I'm not going to go through all of these in detail. But effectively, the commitments are the top 3 are really around what they're committing to doing. So working in partnership with asset owners, setting targets, and then reviewing interim targets at least every 5 years. And then in fulfilling those commitments, there is sort of the first 5 commitments that talk about how they'll be managing their investments. The second 4 sort of talks about how they like sort of the how they will do that. So and how they interact with asset owner clients, and how they'll sort of go about engagement with the companies that they invest in and other stakeholders as well, and also policy advocacy, which is very important, a very important part of it. And will be explored a little bit later as well. And then accountability. So, you know, how will these asset managers be held to account? So publishing TCFD disclosures, climate transition plans, and also other parts of disclosure as well. What I will mention, actually, I'll mention this after the Net Zero Asset Owners, because I didn't mention at the start, is the Glasgow Financial Alliance for Net Zero and how this all relates up to that. But I'll go into the Asset Owners commitment first. So asset owners commitment, it's a commitment statement. So it isn't probably quite as potentially rigorous as you might have seen in the previous one. But really, this is a broad statement. It's about how they're committing to transitioning their investment portfolios and meeting their fiduciary duties. Which is quite important, which is a question that often does get raised, particularly by asset managers around their mandates, very much in the US, where fiduciary duty and being able to change the mandates of funds whilst they're sort of whilst they're already out there is particularly tough when committing to net zero, because it does apply a different lens and may be seen as applying a different investment management strategy. So the fiduciary duty and tying climate change into a fiduciary duty is a large amount of the work that's being done now. So these types of amendments or adjustments to policies and practices can be shown to be in the best interest of members, particularly as far as beneficiaries go, for asset owners like pension funds and the like. There's a part on advocating here as well. And I think the final part here is quite salient as well. The commitments made in the expectation that governments will follow through on their commitments to ensure that the objectives of the Paris Agreement are met. This speaks to some of the work that is done in that industry collaboration. So just going back to this slide, more to the picture, here, the COP26 and the Glasgow Financial Alliance for Net Zero, or GFANZ, as it's known. After a number of these net zero initiatives began to come together, there was sort of, I guess, a bit of a press for one raising ambition ahead of COP, and then broader financial sector, I guess, alliances and broader financial sector cooperation, just because of the interconnectedness of all of the different actors. So Mark Carney, the ex-governor of the Bank of England, who's an advisor to COP26, formed the Glasgow Financial Alliance for Net Zero. And basically what that did was, at the same time, form the Net Zero Banking Alliance and the Net Zero Insurance Alliance, and then house those all under one umbrella, being this GFANZ, and put them in the Race to Zero. So the Race to Zero is effectively the private sector umbrella for net zero ambition, and it has some pretty strict entry criteria and certain governance there. So by putting it under the Race to Zero with all of the actors in the real economy, it's sort to align basically all private sector ambition. And within the Glasgow Financial Alliance for Net Zero, that collaboration within finance and then with the real economy was brought into a few task force and work streams to try and figure out some of those tough problems that are there. And I'm involved with some of these. Just pause.
Could I throw in use the power of the chairman to throw in a question at you? When you were talking about the two work streams of GFANZ, or not the two work streams, but the two signatory organisations, if you like, I'm maybe using the wrong term, but the Asset Owners Alliance and the Asset Managers Alliance. The Asset Managers Initiative is very strict and detailed, quite specific. As you know, it was small font on the on the slide and lots of stuff. The asset owner one was a little bit more aspirational. I think it's fair to say it's probably aspirational might be a stretch, but a little bit less specific. Do you think that either the asset owner one might become as specific as the asset manager one in time? And also linked to that, do you think that there could be part of the asset owner commitments might ultimately be to use only asset managers that have signed up to the other one, if you see what I mean, to explicitly link the asset owner one?
That's a good question, and you could certainly say that the asset owner, the asset manager initiative, which came after the asset owner initiative, was a reaction to that, realizing that that if the asset owner industry is changing en masse to net zero, or to sort of have these sort of broad ranging aspirations to get to net zero, that would directly affect asset managers. So they needed to begin work on how they could sort of align with the needs of institutional capital. So I can't speak specifically whether those commitments will become tighter, though I will say that target setting is probably where most of the rigor, I guess, comes in. And within the Net Zero Asset Owners Alliance, there's a lot of work being done on sort of target setting and influencing both industry and asset managers on how they look at target setting, how they look at policy engagement, how they look at engagement with companies through exercising voting rights within equities and the like. So there could be some further language around that. I think that the larger commitments, which haven't been fleshed out yet, that I think many involved in these initiatives are hoping to come through, especially, I guess, civil society, potentially some of the more progressive actors, are things like statements or positions on coal finance, fossil fuel finance, deforestation, and the like. So within those asset owners, if they have their mandates change to exclude certain types of activities, then that's where the dial will be moved there.
Thanks.
So just going back to the Glasgow Financial Alliance for Net Zero, so there's been some workstream formed. So when the Glasgow Financial Alliance for Net Zero sort of came together, basically all of the CEOs got involved. Mark Carney obviously holds a bit of weight, and had all of these banks and everyone on the phone and said, this is, we need to figure out what we're going to be doing. And so this is what sort of dropped out of it. So looking at sectoral pathways. So if you're looking at certain industries, what does the finance sector agree are the actual pathways they will be using to get to net zero? Now, this can be very important because obviously if different financial actors look at different pathways, then there could be amount of sort of shopping around, I guess, for the best ways to finance to I guess, the easiest or the easiest way to approach it, particularly in heavily polluted or heavily greenhouse gas emitting sectors. Finance transition sector strategies, and that's really about how finance sort of sets targets and how you change how finance is done from an operational level, particularly important, I think, for very large, multifaceted financial institutions. So how do you change an organization like HSBC or Aviva who are heading this up, and make sure that their business models are changing in line with what they'll be doing in interacting with the real economy. Portfolio alignment, I'll talk about that shortly. That's to do with target setting. The GFANZ communique or call to action is now actually called the GFANZ policy subgroup. So there has been I can share it afterwards. There is a GFANZ call to action to the G20 ministers that was just released a few days. And that goes back to that statement at the end of the Net Zero Asset Owners Alliance that there is all this ambition in the financial sector, but a lot of it relies on policy change, and they've outlined where they believe they will be, and that's work ongoing. That might be drilled down into country or region-specific sectors around what policies may need to be changed to help in their work. The task force I'm involved in is the corporate transition plans. So we're looking at effectively how to look at certain industry sectors, and if they're setting targets, to look at what their change management structure, what their plans look like. So if you're looking at things like, say, proxy voting, or even just screening for portfolios, or in the other sense in lending, if you have sustainability linked products like a bond or even a loan, what does their transition look like? Is it that you can set a target, but how you actually, your direction of travel, your corporate strategy, et cetera, might diverge from that target. So how do you align those two, and how are financial actors able to quickly assess that or look at those when screening companies? And the final one is the mobilization of capital in emerging markets to make sure that finance is available for these countries to decarbonize in a way that it's, I guess, it is distributed in developed markets where they might have higher credit ratings and the rest. So this is very much around public-private partnerships, working with development financed institutions. So at that stage, I'll pause once again if there's any questions on that. That's really the background on sort of net zero, and then I'll go into a quick run through of sort of the way we look at how the financial actors we work with go through that.
No questions in the chat yet.
Okay, no problems. Well, I'll kick on and I'll talk about it. I guess this from the perspective of my team's work and the broader capital markets team's work on engaging with financial institution or financial actors in net zero. And this is talking particularly about initiatives we're other partners of, or that we actually we are in the market doing. So the way we effectively see it is it's an ongoing process. Integrating net zero, so I was sort of talking about those corporate transition plans. There is financial, obviously, transition plans. It's change management, really. And it's really integrating, I guess, in a lot of senses, these non-financial in the ESG elements within the business as usual. And you would hope over time, could be 5 years, could by the end of the decade, that there's not separate ESG teams necessarily, or separate separate pools of data that you need to put in with financial data or any other due diligence data. It is just another aspect of what you're doing, and a key consideration, considering that the legislative and regulatory environments by then will likely change. So where a lot start, this diagram is supposed to show that there's no place to start, that it's ongoing, is really on data and engagement. In order to set a target, in order to look at net zero, financial actors' largest emissions, they're financed emissions, and so you need information from the companies that you either invest in or lend to. So we have a capital market signatory program. We have other sort of private request programs where, as you may or may not know, CDP's I guess main function is a platform for engagement between financial actors and the real economy. So asking them questions about environmental metrics, and then feeding that data back in useful ways. We also have campaigns, non-disclosure campaigns, to get more companies to disclose. The Science-based Targets initiative campaign, So requesting companies set science-based targets, which I'll go into more in a bit later. Say on Climate campaign, which is really about proxy voting and as you've seen recently, especially with some oil majors and some larger banks, voters sort of asking these companies to put into place climate transition plans and talk about how they do that. And also capacity building within the institutions themselves, and some of the more progressive, progressed might be the word, further along this journey are now working with their stakeholders and counterparties and clients and investee companies on raising their capacity as far as these things go. So how they do ESG reporting, how they look at carbon emissions, etc. Moving on to target setting, which I'll go into more detail. You sort of have all of that information so you can start to build a target and look at what it might look like in the future. And then the next part is portfolio alignment and transition plans. So once you have that target, how do you actually implement it, and what does that look like in action on an ongoing basis? How do you do that? And the last bit is reporting and validation. So for the financial actors themselves, especially if you commit to net zero, you need to report that, and obviously there needs to be, and over time there'll be probably increasing measures taken on assurance and validation to make sure what's being said is being done, which isn't quite the case yet, but which we believe will be certainly in Europe and the UK should be mandatory in the next few years. Can't see any questions. I will skip through these. I've sort of talked about these, and you may know about these in detail. I'm happy to speak about them more in future, but we have a number of different data and engagement programs. I think it's what CDP does best in sort of, our network of civil society actors. We want to really be in the middle of helping financial actors engage with the real economy. And just, a bit of a graph, it works as far as that goes. So as companies engage with us and the people request, or the financial actors requesting their data, their ambition increases. So they set targets and they have emissions reductions initiatives there. And the saying we say is you can only manage what you measure. You can't do financial forecasts without doing your accounting first. So it does work. You might have seen announced, we've had over 13,000 companies disclose information to us this year. That's up 26% on last year. So it's certainly increasing at pace. Now I'm going to go into a bit of a deep dive for science-based targets. There is other target setting protocols. Some you might have heard of is the Paris Aligned Investor Initiative's Net Zero Investment Framework. There is also the Net Zero Asset Owners Alliance target setting protocol, which applies to both asset owners and asset managers. I can speak a little bit to those, and they are very rigorous. They're approved by Race to Zero. I'm just not an expert, so happy to answer any questions as I might, and even direct people to those I know in the industry who work in those. The main part I will highlight here is that there's 3 approaches, which I'll go into on the next slide. And the Science-Based Targets Initiative is convened by the UN Global Compact, CDP, the World Resources Institute, who came up with the GHG protocol, and WWF. And we all put together a team that sort of sets a third-party target setting and validation mechanism. So there's an assurance function there. So you set your targets and you submit them to be approved on an ongoing basis, which as of now isn't legally required, but in the future may be. So we are finding the institutions we are working with on this are doing so on the basis that they know in the future assurance will be a big part of this, and they'd like to start how they mean to go on. So again, very busy slide, and I can send some links to the full methodology, but this is just a snapshot of how you sort of think about setting a science-based target. So firstly, you set the boundary. So you set the boundary, what is going to be covered. So some things just aren't covered. Derivatives we don't cover. Sovereign and government bonds currently aren't covered, but we're looking to hopefully cover them as well. And they're just reasons because the methodologies haven't been worked out. We're sort of working this out on the fly, and some of these are quite brain busting when thinking about how to attribute emissions to certain types of asset classes. But for this one, for listed equity and bonds, within the boundary, stocks, ETFs, and equity REITs. So if you have those, that would form the boundary. So they're the assets that you're going to be looking at to set your target to. Step 2 is calculating the baseline. So then you, using the GHG protocol, you would sort of measure, so carbon accounting, you'd measure the emissions per loan of investment, and then you calculate your institution's share of emissions. And this is generally, and again, this isn't mandated, but I think it's the most broadly used and will become the industry standard. It's called PCAF, the Partnership for Carbon Accounting Financials, started by a bunch of Dutch banks who wanted to sort of figure out this problem, and is now sort of worldwide. Every net zero alliance uses PCAF as the basis for carbon accounting for financials. So effectively what you do with PCAF is you sort of calculate emissions per the asset class, and then you attribute those emissions to your share of those holdings, and then calculate an emissions intensity. So there's a full guide on PCAF and how it works. There is teams in every mid to large accounting firm and the related consultancy firms who do work on calculating this now. And then from there, once you sort of have that, you sort of know where your emissions stand, then you figure out a way you need to figure out your methods to decarbonize. So there's 3 of those main methods. Just pausing there if there is any questions, or if I'm talking gibberish and you want to know more.
Just on the PCAF question there,
Sure.
Is that measure essentially the same as the weighted average carbon intensity that I would say a reasonable number of people are familiar with and are using within the industry? Is that the same, or indeed is it the same as the carbon footprint, or is it different to both?
Yeah, so WACI is a footprinting method on the portfolio level. You would use PCAF to get there. So you'd use PCAF to sort of do the accounting. PCAF is, think about PCAF is more about the accounting behind. So you sort of do the financial greenhouse gas accounting with PCAF, and then WACI is a methodology that you can use to look at that portfolio and have that weighted average carbon intensity to do that. So yeah, they're certainly related.
Thanks.
And then, so selecting the methods. So there's 3 main methods in science-based targets for financial institutions. The first is a sectoral pathway, the sectoral decarbonisation approaches. So for science-based targets in the real economy, certain sectors have different certain approaches that they use to decarbonise. It's based on effectively looking at certain scenarios. Generally IEA, some IIGCC scenarios, then looking at that particular company, its growth trajectories, etc., and looking at allocating its sort of fair share of the remaining carbon budget, and then what a decarbonisation approach would be for that company there. So some financial institutions, generally specialist banks, etc., who have large exposures. So some of the sectors covered there, so heavy industry, electricity generation, project finance and the like, they might use those pathways to look at their overall reductions, because they might have quite a large share of that industry's emissions or financed emissions in what they do. Now, the other 2 methods, however, are more around engagement. Very, I think, as far as investors go, they're the ones where most, we see most targets covering, using these 2. They're similar, but they work in a little bit different ways. The first one is a portfolio coverage approach. Effectively, a company says we will have X% of our portfolio that have science-based targets, in a trajectory that means that at some point, over 90% of the companies within their portfolio will have science-based targets, and therefore their financed emissions are on the path to net zero. So that's quite a simple way to do things, because effectively financed emissions are a financial actor's financed emissions are just an aggregation of the emissions of the companies they invest in. So if those companies are taking action and setting targets, then that just aggregates up to portfolio level. The second one puts probably a little bit of extra calculation complexity to that, but it's generally used to be able to, I guess, compare apple and oranges, and internally and externally convey decarbonisation or the trajectory in a simple manner. So that's a temperature ratings approach. So that's taking any target that a company sets, not just science-based targets, and through various methods of calculations. CDP, WWF and WRI have our own that we've come up with. It's open source. You can have a look at it. Then there's other, private actors, etc., out there, consulting firms that have their own temperature rating methodologies, all doing very similar things, but effectively taking that target and putting that as a temperature. Now, temperature is just used because 1.5 is the target, is where everyone wants to get to. You could use a 1 to 10 scale, but they've chosen temperature. So it's an implied temperature rating of that company. So that company's targets mean that they will likely hit 1.8 or 2.5, or if they have no targets, we say 3.4. And that again is aggregated up to company level to have a portfolio-wide sort of temperature number. So again, it's a little bit complex on how you calculate it to get it there. But for say BlackRock are using this approach, not using the CDP methodology, using Baringa, a consultancy's one, and there's various others that we're working with that are using our approach. If you have lots of different investments in lots of different places, sort of internally and externally, as long as you're comfortable with the calculation method, it becomes a bit easier to talk about a 2.4 degrees company compared to another 2.4 degrees company without having to talk about all the calculations below. So again, we effectively see these sorts of methods, those last two engagement methods applied in investing, because engagement is a large part of investing, and we don't necessarily want to see, and I know lots of asset managers and asset owners don't want to see companies simply divested because they don't meet that sectoral pathway that's there. It's more about engaging with that company, saying, we want to keep this relationship, but we need to see that your trajectory is on path to that 1.5. The last bit of technical deep dive I will do, and then we'll open up to some questions, is just portfolio alignment. So this is what I've sort of briefly talked about, but effectively, this is what is done on an ongoing basis. You've got the normative benchmark against which to measure your performance. So that is that science-based or that sectoral pathway, and so this is the benchmark that we need, each company to sort of go against, and then you measure that, you quantify the company performance against that benchmark. So you sort of say, okay, well, their trajectory is actually, it's not quite meeting, it's sort of outside, and then you aggregate that all up to portfolio level. So you can, on an ongoing basis, see how your portfolio is aligned, and then when you drill down into the company, see where you need to engage or take action or whatever the case is. So the methodologies that we have is sort of SBTI and PCAP. There is also PACTA as well, which does this work in portfolio alignment. And I guess the tools to get there, or how you get there, is sort of using, say, data that we provide. So we have CDP reported data. You can also use, modeled data, which we provide and others provide as well. And then we also have some information. If you do see CDP data, you will see targets. We have like a question around targets. So if a company has a target, you'll be able to sort of map out what their trajectory is and see if that's in place. And there's obviously some various other methods there. And once again, PCAF is sort of the underlying carbon accounting that goes on behind all of this, whether you're using science-based targets, whether you're using PACTA or other target setting protocols. PCAF is sort of the language that I can't think of an institution that doesn't use it, to be honest. Let's say 99% of the industry is using to do that. And really that's it from that perspective. And then there's obviously reporting and validation. So this is for investors themselves, so not for the companies they request. I know in the EU it is coming along. In the UK currently, all asset owners and managers, listed or not, with assets under management over 5 billion are requested to do TCFD aligned disclosure, and that'll be moving down to 2 billion, I think, in sort of 18 months time. So again, reporting and validation, making sure you have the teams in place and you're able to sort of bring in the information to effectively report against these targets. And even if you haven't yet set a target, at least against TCFD, which is a great starting point. And I'll just wrap that up with key takeaways. So yeah, the net zero alliances and initiatives are about the finance industry working together. Data and engagement, from our perspective, are the keys. You can't do any of this without getting data, and you can't get data without engagement, which I think is the way to go about it. Just divesting from a company doesn't solve the problem. They will seek finance elsewhere, and the emissions don't go away. yeah, there's no one starting point. It's an ongoing process. I've seen many asset managers commit to net zero without really thinking about how they're going to get there. And I talk to others that are incredibly careful and want to make sure they have all the data in place before they even think about, committing to net zero and even having the target set. I would say both extremes. You don't want to let perfect get in the way of good, because you might never take action. But on the other side, I would say committing to something you don't understand probably isn't the best way to go about it. And leading up to COP, when you have to set a target, consulting heavily with people like me can become very hard because I get very busy, and suddenly you need to make an announcement before the 3rd of November, and you don't know how you're going to get there. That's probably not a great way to do it either. So that's all from me. Thanks for your attention, and really happy to take any questions or comments or thoughts.
Oh, thanks, Mahesh. That's a tour de force of the amazing amount of activity that is going on in this area. Thank you so much for that. I know we've all found that very helpful. Kathy, I know you had a question you wanted to get in on there. Sorry, I should have said we'll open up to questions here for about 10 or 15 minutes. Kathy, I know you had a question you wanted to ask.
Yeah, great. Thanks very much, Eoin, and thanks, Mahesh. That was really excellent. My 2 brief questions, if I could, hopefully. One, with regard to the Paris-aligned investment initiative, you mentioned that asset managers will have to create products aligned with net zero. Will those products have to be measured versus the European climate benchmarks, so either Paris-aligned and transition-aligned? And then secondly, also with regard to providing clients with information on analytics on net zero investing and risks, climate risks, I believe with regard to all assets under management, will that need to be provided on an individual portfolio level, or would it suffice on an entity level? And are there deadlines around both of those for timelines?
Good questions. Yeah, both of those are, I guess, at this stage more aspirational. What it's meant to be is signaling to clients, being the asset owner community in general, that in setting this commitment, they understand that the products and services that they create, and also the reporting, will need to be in line with net zero. So they'll begin the work to ensure that as time goes on, they'll be there. So there is no commitments as to timeframes or exactly what that looks like. Obviously, in jurisdictions where there is regulation around it, it would need to comply.
Kathy, had you a follow-up there, or is that?
No, that's absolutely fine. And I think Pat had a question.
I can see Patrick.
Thanks very much, Mahesh. And Eoin, good to see you again. Hopefully we'll get to see each other in more favourable circumstances together shortly. Mahesh, I have a question just around the dichotomy, if you like, between the specificity of the asset owners versus the asset managers' commitments. And I'm curious if there's a principal agent conflict here in some respect. So the asset owners refer to their fiduciary obligations, and is that leading them to be more cautious? And are we as agents being more aggressive than our principals are? Maybe this is a question about what is the debate within the asset owners that's restricting them from being more specific on their objectives.
Yeah, that's. I guess this will be me answering in any non-official capacity, so albeit as my own. But yeah, I think there may be people from both parties here as far as asset managers and owners go, but asset owners are generally more conservative and sort of think about things in larger scales with like less detail than say someone managing portfolios on an active basis might, or even building products might. In many cases, but not all, particularly probably not insurers, they're probably a bit more resource constrained as well. To be able to sort of dig deeper and make some of those commitments. But yeah, I think the types of people that, and I'm talking about people that work in those industries, are in say stewardship positions at an asset owner versus an ESG specialist portfolio manager at an active investment manager are just very different people and approach things in very different ways. I can say the conversations between asset owners and asset managers around temperature alignment. I think there's been public statements from certain asset owners in the Paris Aligned Investment Initiative, basically saying that they don't want to see temperature ratings from their asset managers. They think it's it's convoluted and unnecessary and could obfuscate what's actually going on. And asset managers say, this is the easiest way we can describe it to each other. So yeah, there is a bit of that. There is a bit of, I wouldn't say conflict is the word, but there's divergence of ideas there. And I think that, and I think personally, that's why the asset owners' statements are quite broad, because they want to reserve the right to sort of make some sweeping changes in their mandates without being sort of caught in the specificity of what they're doing.
Understood. And thank you again for this morning's session. Very, very insightful. Much appreciated.
No problem.
Mahesh, can I ask you about asset managers' emissions from their own operations? So we've talked, for obvious reasons, about the emissions from investment portfolios, the need to reduce them to net zero, etc. Is there, as part of, for example, the Net Zero Asset Manager Initiative, is there a requirement to reduce our own emissions in terms of business travel, company car fleet, electricity purchases, and so on, to net zero as well over time? And I suppose if not, why not? Is it that it's too small to matter, or is it just taken for granted that we should do it anyway, and so on? Could you just address that side?
Yeah,
of things?
absolutely. Yeah, that's covered in the target setting protocols. If you set aside, I think with all of them, indeed, if you set one of those targets, scope 1 and 2 emissions from operations and electricity purchase, etc., are covered in that. And depending on the size of the company as well. So if you're a multinational bank with 15 offices across 10 countries, scope 3 supply chain emissions would apply there as well. So within the science-based targets methodology, didn't touch on that, but there is approaches to that. In reality, from what we know, in having sort of over 1,000 companies in the real economy set science-based targets, those particular sorts of targets are quite easily put together for services companies, so professional services companies. So the focus, I guess, or the discussions aren't so deeply on there, because it's a relatively well-trodden path with some pretty good guidelines out there on how to go about that. So yeah, it is certainly covered. And I think what we are seeing, and what I have been seeing, conversations I've been having with probably smaller boutique outfits, and certainly some asset owners that, as I mentioned before, probably don't have the staffing levels, pension funds and the like. We're getting a lot more questions around how they do that, how they look at it, how they measure, using the greenhouse gas protocol, not PCAF, so the basic carbon accounting, to sort of understand that footprinting, and all of that support is available from the Science-Based Targets Initiative anyhow. There's lots of tools and calculation methods and also conversations you can have with them on doing that. So yeah, certainly involved. To date, not talked about a lot, but yeah, certainly something that is coming up more and more as we get smaller, I guess you would say, actors looking to join these initiatives.
And can I turn to offsets, Mahesh? So I had a kind of a funny exchange with a friend of mine who rang me, obviously very concerned about these issues. He called me the day of the IPCC report came out, the world is burning type of report that came out there, it must be 2 months ago now. And he wanted to know what he could do himself and the rest of his family to address climate change. And we went through the various options he could do in terms of changing what he does. Buy from a renewable energy supplier, eat less meat if he's that way inclined, electric cars, that type of thing. We went through that. Then he called me back the next day and said, hey, this is a joke. I just discovered that I can offset the entire emissions of my family for, I don't know, 100 or 200 euros or something. Wouldn't it be a lot easier to just do that? So if we apply that out to, I was struggling in a way to answer it, but if we apply that out to institutions or investors or people making net zero commitments, whether that's individuals, whether it's corporates, whether it's investors, offsets is obviously an option. We know that you can go into many places and buy the offsets. Can you talk about whether that is, shall we say, well regarded or best practice, or when it's best practice and when it's not, and the various issues that arise around offsets, if you could.
Yeah, no problem. And this is going back to a point that you asked me to cover that I forgot to cover, which is sort of net zero versus carbon neutral.
Yes.
So offsetting, I think, is when you're talking about carbon neutral, that's really about offsetting. Now, that offsetting can happen in a process. So say something like biomass, bioenergy with carbon capture and storage. That's a carbon neutral or carbon negative process because throughout that life cycle. So you can sort of see where that makes sense there. But then when some companies say they're carbon neutral, they're effectively doing one thing over here that produces emissions, and then doing another thing over here, buying carbon credits or offsets or the like, that is supposed to net that out. I think the issue with that is that the veracity of those offsets and how the carbon abatement as opposed to carbon reduction is calculated is not very well done. The auditing of preservation of forests, and then you've got the unfortunate problem, speaking from an Australian, is that forests burn, and that releases all that carbon very quickly. And for a tree, I believe, to get to the point where it absorbs that carbon, I think it's 100 years. Don't quote me on that, but so to plant a forest, to plant a tree, great thing to do. It does produce more of a carbon sink, but it doesn't do what a tree that's been there for 100 years does. And I think if you go onto Bloomberg Green, it counts down the football pitches of trees that are getting cut every hour at pretty much 1 a second. So it's a bit of a it's a bit of a knife at a gunfight, I think. In the target setting protocols, so science-based targets, all of them, offsets aren't counted in those reduction plans. However, there is, there does need to be a net zero. There is carbon in everything we do. If you build a wind farm, carbon's released. If you make a solar panel, carbon's released. There will be carbon emissions in some way, shape or form. It's hard to decarbonize sectors. There's thoughts on how to do that, cement manufacturing and the like, but people don't know that yet. So there will be carbon, but it's obviously the rate of carbon in the atmosphere and the rate of drawdown. And there is unlikely, though we hope there is, enough to be natural carbon sinks being, the oceans and trees to suck that in. So there is some net that's required. But again, those currently aren't counted in targets, but there is an understanding that sometime in the next decade, so sometime in the 2030s, there will need to be an understanding, and that will need to be built into targets. A quick thought on what the finance industry is doing, I guess, looking at that, and we're doing some work with Breakthrough Energy Ventures, Bill Gates venture capital fund, or Bill Gates and SoftBank led, I think, in looking at accelerating the uptake of carbon reduction or highly decarbonizing innovations that aren't quite there yet, like sustainable jet fuel, like direct air capture, so just literally sucking carbon out of the air. They're not quite there yet. They may never be there, but they're solutions that are probably going to need to be there to put that net in net zero. So they need to be thought about. They need to be financed. They probably need to be financed at a loss by corporations, investors, everyone, governments especially, because the likelihood is there will be a certain point that we get to, if everything goes well, that still won't be enough to sort of limit warming below 2 degrees, which is where it starts to get pretty bad. So there'll need to be other things that are happening there, but they are being addressed sort of on the technology front. As far as decarbonizing industry as it is now, offsets currently don't count.
Thanks, Mahesh. And Kathy, I see your hand up there. Want to come in?
Thank you. Mahesh, just one last one to the science-based targets methodology. One of the methods you mentioned, the portfolio coverage approach, mentions that X% of the portfolio needs to be science-based aligned. So I think currently the MSCI ACWI, there's about 15% of the underlying constituents that are science-based aligned. Equally with the engagement approach, where there's an obligation, I suppose, to evaluate the temperature or target setting for the underlying individual companies. And I think tools are beginning to emerge around how we evaluate those. But for example, Unilever's net positive goal versus Microsoft's net negative, etc. So how do we evaluate one versus the other? Is there any context within the science-based target as to how one deals with that in a passive management capacity, where there's restriction around how a portfolio is constructed, perhaps?
Yep. So yeah, on the first one, so the portfolio coverage approach is really the easiest one or easiest in theory, but it's about just, you can point to, here is a science-based target. There's a third-party validating mechanism. It's widely recognized as sort of the gold standard for a company to set a target, and pointing those towards that, and it potentially being part of, one of many target setting protocols that the governments may regulate or legislate. So we think that will increase over time. Temperature ratings is going back to that sort of apples and oranges point. So the temperature ratings methodologies, and there is more than just the science-based targets one, which actually goes into breaking down those targets and then sort of reconstructing them into that temperature approach. So as I mentioned, there's off the top of my head, so Baringa has one that they're working with, which is a consulting firm. With BlackRock, there is Arabesque. There's a few others. There's actually a report, I will share that as well. The portfolio alignment team just did a report on this with the TCFD, which is part of GFANZ, looking at the different ways of doing this. But yeah, really looking at the different types of targets of companies and then reconstructing them. That's what portfolio temperature ratings or implied temperature rise looks to do. The issue that many have with it is that it's a bit of a black box and it's quite complex, and it's hard for outsiders looking to understand. The final part of your question, as far as passive products or passive managers, I guess the approach we see there is passive management but active engagement, and then that comes through things like looking for shareholder resolutions, etc., and proxy voting, etc. So obviously within the portfolio construction, there may not be the ability to divest, which again is I think the least favourable option. But using that active engagement with the companies through the voting mechanism of being a shareholder to sort of get that action within those companies. Broader network effects being, if there is a number of net zero asset managers and or science-based targets initiatives signatories out there that hold this company, the more likelihood that you're able to affect that change.
Thank you.
No problem.
Thanks, Mahesh. It is 10:59 according to my clock, so that brings us neatly to the end. I had at least another 10 questions I could ask. It's such a broad issue, and it was fantastic to get all that feedback, and I see comments coming into that effect on the chat as we speak. So well, we will finish up on time. In fact, it's just leaked over to 11 o'clock, so right on time. So thank you very much, Mahesh, for giving us what really was indeed a masterclass this morning. Thank you all for joining us. We will circulate the slides in due course. Lots of fantastic content in them. Thanks to you all. Enjoy the rest of the day. I see there's another session on called the Green Pledge for fund managers in particular is the next event at Climate Finance Week. I'm sure you'll all agree it's been a great program of events. So that one is just kicking off now. So feel free to jump over there. Meanwhile, enjoy the rest of the day and have a great weekend. Thank you to everybody.
Thanks, everyone.
Thank you.
Have a good day. Bye-bye.
You.